When it comes to a sale, I think that the most amazing thing we do our assessments is how much money is just sitting within the business already, because no one's peeled back a couple layers of onion to look at your software spend, to look at your insurance. So like the programs that you've just kind of accepted as this is what.
We all exit our company eventually. The question is, will it be on your terms or someone else's? Strategy matters. Timing matters. The right partner changes everything. Brought to you by Meritage Partners. Here is your host, Brian Franco, author of The Inevitable Exit. This is the M&A Guy Podcast.
Most entrepreneurs start their businesses to create freedom. Yet many unintentionally build companies that just simply can't survive without them. The result, they have the revenue growth, but stress grows alongside that. And the enterprise value is still stalled, right? So we're trying to figure this out, and today's episode is framed around that. Today's conversation is for you as founders to break through that cycle, just doing things on your own and finding pattern and a pathway to building a transferable company. So with me today to highlight this topic, and by the way, we titled this episode The Exit Operating System. We're going to talk about financial leadership, strategic growth, and building a scalable and sellable company. And joining me to talk about this, I have two gentlemen here with Vessel Advisors, Brennan de Raad and Josh Walters. We've worked with them at our firm, M&A Partners. They've been deployed with a few of our clients and had a fantastic experience with them. So without any further ado, let's dive in with Josh. Brennan, good to see you guys, good to be with you guys.
Likewise.
And looking forward to backing us, yeah. So tell us, when did you guys start Vessel?
So Vessel goes back about 10 years. Yeah, I've been about 10 years in October. And the original vision was I was sitting as a VP of finance controller and then had a lot of different jobs to do, some of which I knew how to do, some of which I didn't, and limited budget. And I always thought, man, it'd be nice if I could have a little bit of fractional, CFO, controller, bookkeeper, FP&A, all these different pieces. And so I'm going to fast forward 10 years later, that's doing that for all of our clients and many other transactions.
Yeah, great, love it. So you're going to have a lot of case studies. I know you can't talk about client names and things as such, but we love case studies, good, bad, ugly, all the above. So don't hold back on this. So I want to ask you guys a few questions, and feel free to answer whoever wants to talk through this. But I always talk about income versus outcome. So we as founders and business owners, we build our businesses to generate an income to sustain a lifestyle we've always wanted. The outcome is they're building an asset as well, whether they realize it or not. And that asset has value, enterprise value. The enterprise value of that company is formulaic in nature. What we find often in M&A transactions is the transferability of that revenue or that asset is typically suffocated with deal terms, right? Because deal terms like contingent payments, earnouts, as an example, we don't like them personally as advisors. I don't like them as an owner. But if they're there to help benefit the enterprise value, fantastic. But we have to understand what's being measured, what's triggering the measurements, how is it being measured? Because if we can't agree on the math behind the measurement, it's going to be very complex. And so if a business owner does not prepare for these things, keep in mind, you've been through integration. A lot could get lost in integration, mapping data incorrectly, wrong sales reps assigned to wrong revenues. And the outcome of that is the set burnout targets are not met because they weren't measured correctly because the data coming in was bad. So we like to spend time with our clients before we go to market to situate the financial hygiene of their company, the KPIs that apply to what they're doing, that not just for the purpose of the sale, but also for the purpose of the integration. Because if we're going to have those contingencies, okay, let's understand how we get there, how we measure it, and again, what's triggering it. So with that said, your work at its core is really focusing on the financials of the business, how the health of the business, and telling a story with those numbers. And so have you, from that standpoint, Brennan or either of you, Josh, What do you find that founders are doing that really disrupt what I just described?
Yeah. I think founders, there's several things. One, founders typically are reliant upon their product or their sales abilities or their operations. They don't think about the other systems that they need, right? So most founders, and I speak for myself and my first few companies, the finances were just a way of keeping track, keeping score. But I didn't use them as a game plan. And so I think looking across the board is like there are other pillars they've got to focus on. Is just that, right? They don't think that's going to enable the business to do better, to fund better, especially if they haven't hit that peak plateau yet, where things are growing and things are working fine until they're not. Then they don't look at finance as an account, right? Looking historic versus forward. I think that's the biggest missing piece is they haven't seen it themselves.
Yeah.
Because a lot of entrepreneurs are not, right? I'm not the smartest guy in the world. I just was willing to take some risks. And because of that, I found some success. I think a lot of entrepreneurs are similar, right? They are willing to take a risk, at least initially, but they're not coming from these strong financial backgrounds of running their own business with those numbers.
I would add to that just to say they're not starting with the end in mind. It's more day to day, week to week, month to month. Some founders are very comfortable with very tight cash set goals and they live that way and that's their lifestyle. Others need 3, 6, 12, 18 months, depending on the whole list on it. What happens a lot though is that they've never heard of some of these deal terms. What's my cost of acquisition? What's my customer lifetime value? What are the things that the banker or the team that's going to come in and analyze the business, the analyst is going to pick at? But that data doesn't even exist. That we haven't even started. But we're so far away from that I think that's another huge gap that they're not aware of. And just running a business to generate cash flow to sustain a lifestyle, or maybe sustain a lifestyle plus a couple other things. And that might be another little hiccup there is your lifestyle starts to grow. So when you're looking at exit or percentage of that deal that's going to be sold, all of a sudden it's like, well, I'm taking X amount of dollars out there, not already in excess of my salary and my lifestyle needs that. I haven't lined up those two things. I haven't made a plan. I'm not sure business significantly for the personal. I think you see that a lot too. Or you get towards the end game and that individual goes, well, actually, I kind of need an X dollars per month. I need 100,000, I need 30,000 a month to sustain. And I actually can't take a continual job with this company unless the salary meets that post-separation.
Yeah. And I think that's a false sense of accomplishment is that when they're earning money or they're earning income, that doesn't necessarily mean they're building an enterprise value or a transferable company. And so we get to this place that we feel satisfied. It's a false sense of accomplishment until you start looking deeper into the numbers, into the story. And what we find there is that bottleneck, it creates a bottleneck. And that bottleneck comes to life when there is underwriting involved by investors and lenders and whatever the case may be. Let's call it a capital event. That capital event, someone's going to be looking very close and they're going to be making measurements on a business that you've never thought of as a founder. You never thought about because you weren't aware. And that's really what's important here to what both are saying is that they need to come to the light of here's what we need to be able to articulate. Here's what needs to be said in these numbers, because just coming to the table with a P&L and balance sheet, it's not going to get you to the closing table or beyond, right? You need fill in the blank.
Yeah,
right?
what I'm thinking of is sometimes a client will come in and they tell them the difference between you learning all of this maybe 2 weeks or 2 months before they get into the deal transaction, you coach time versus 2 years before. You look at that metric every month or every week you run. And as you sit in a meeting, maybe a management level meeting with a potential buyer or post LOI, that person across the table realizes you're speaking their language, and we've already been training on that. And it's just osmosis. It's like you can look at your dashboard every week, they're the same numbers, and so it's part of your vernacular. It's not a new thing that you're kind of you're not saying. Hey, did I say that right?
Yeah.
Table. It's natural.
It's natural
business.
It's correct.
Based on
Yeah.
Love it. So we talk a lot about founder dependence, and the reality is, this is a silent valuation kill, the dependence on that owner of that business that they intend to exit at some point. And you both have been through many exits. You advise hundreds of clients on this preparation, but personal experiences that you guys have seen. I want to get into when you're advising these founders. What role does the founder's dependence play in valuation as you've seen it? I mean, I'm the deal guy. I could talk about it all day long, but I'd love for the audience to hear your take and experience.
Yeah. So I think there's two things. I think the evolution of deals as a whole have evolved significantly from the last 10, 15 years.
Oh, absolutely.
Right? Private equity has always been around, but all of a sudden scaling it and so active. So we number transactions, which has created some education. But the number of times, and just for context, right, I sold my executive search firm in 2001 merged it because a lot of my clients were planning for an exit, and the idea is let's get the owner out of the way and increase value, or let's build a team that sustain the deal and grow and adds value. But clients didn't understand that there's this idea called discount, right? And so they hear the valuation story, valuation sounds sexy, and then they sit down with someone who starts tearing things apart and says, oh, discount. And that discount exists in a lot of different areas, right? We mentioned sales, product, but financial structure, readiness, having the story that goes with it means everything. So I think that discount idea is almost foreign, but someone's trying to pay you for your company, they're going to find a deal. They want a deal, right? And they're much more experienced than the average owner. So they're going to pick things apart. So even the idea that there's a discount or can be a discount is foreign.
Yeah, it is. And the discount is commonly discussed as, investors being sharks or investors being aggressive, right? But the reality is, and I remind people of this, if you are listening and you are an investor, you are going to have to underwrite these investments because your job depends on it. Your fiduciary responsibility is to make sure your LPs and your GPs are satisfied with the investments you're making. So yes, it's a discount. What founders hear is, oh, they're just trying to get me.
Right.
The reality is, imagine if we could show founders how to transact without a contingent payment, because there's a way.
Yes.
So in some folks listening are saying, well, what's an earnout, right? Because I'm saying, we'll teach you how to sell your business without an earnout, but you have to understand what an earnout is.
And dependency.
Yeah.
So that's most other things. Yeah, I'm thinking of a couple examples, but probably the biggest one is actually an advisor and a company that tried to go out and transact, and they were not successful. And I would say, to your point, there's a multiple range, right? Within the industry or size, there's these ranges.
Right.
And so the discount is maybe the different way to frame it, whether it says, let's say the range is 6 to 8x or 8 to 12x. You guys do that. Things like your acquisition cost, your long-term value, your customer lifetime value, especially founder dependency, is that's where the levers go. And then how much of that 100% of the 8x, 9x, 10x, 12x even do you get to get on day one or at closing versus what is at risk? Because now you're behind debt, you're behind a whole bunch of other covenants, you're probably not a preferred bucket. All these things that you'll learn as an owner of some business. You met your cash up front. That other 40%, 30%, 20% is you're letting it ride.
It's at risk to do.
And maybe the second point of that example was that individual team. He was extremely involved. He was still the executive. He was running meetings. He was leading the leadership team. All these things. To Josh's point, that the banker came in and said, "Hey, you're on the low end multiple range. Even if we're able to transact, here are the things you need to do in order to fix that." So come 2021, they sold for 16x. That individual was showing up at quarterly board meetings. Right? So he got the message over a 3-year period. He'd hire and train and move myself in every minute. You're not just firing yourself in different roles so that you can free time to grow. You actually need to be firing yourself from all roles.
Yes.
So that business is running almost like running a body manufacturing business where the floor is running. Yeah, sales come in, the floor runs. Like services, harder to do that, but it has the mentality. Took a painful learning. Went through some of the things that proved the business was extreme.
We had a guest on the podcast about a month ago, a client of ours sold his business for 17x, but spent 3 years marketing the business, failed attempts on sale. So instead of being discouraged, he took that as education. And every single piece of feedback that he received from different buyers and different groups, he took an inventory of that and said, okay, here's what's is being found is wrong with my company. And he did the right thing. He went in, and this was before meeting us, did the right thing and fixed those things and cured those things in the company. To the point when he was ready, they did go to market, and he sold for 17x. It was an $85 million transaction. He was 80% shareholder, and he's happy as can be.
Yeah.
But it took him 3 years to figure that out on his own. And so the beauty about this conversation, the work that we do, the work that you do, we have a time machine. We could collapse time and get through that work in a much shorter period. Ideally, we like 12 months so things could cure and give them a place and you can see the results of the movement and the changes. If we have to compress this down into 6 months, we could, as you both know, but 12 months is a good starting point. 18 months is ideal. 24 months, you'll have less anxiety and less fatigue as an owner of a company because you're advertising that workload over a longer period.
Yeah.
Right. But what were you going to say?
No, I was saying is you can turn a light switch and get the work done, and you're going to pay some advisory fees to get it done, right?
Yes.
And it's across the board. It's your entire advisory structure will. It's a
It's
a lot of time.
Yeah.
But the idea is you're running a healthier business. It's not just the idea of let's make it ready for sale. Running a good business is running a good business.
Yeah.
And it also becomes sexy and attractive to a buyer, right? So it's the sooner you address the things that need to be addressed to create a healthy business, it's lifestyle, let good things happen. And now it's a trend. It's not just hey, we can do this. You actually have that trend. This is where we're going.
Yeah. So I bought a couple businesses along the way and sold them. But I was constantly telling my team of those relative portfolios is that we don't just want to build a business to sell it, we want to build it so it's irresistible to investors.
Yeah.
And we're not only building it for the purpose of sale, we want to build a first-class company that investors are begging for, right? And if you could have that approach and build your culture around that messaging, that's where the magic happens because we're not just trying to do things on a temporary run to get to the closing table and get to the liquidity there. Because to your point, if you're young enough and healthy enough and you have the time, you can live beyond the transaction closing date form of a minority equity holder. That equity is at risk, of course, but those that prepare and execute correctly can be worth 2 to 3 to 4 times in a 5 to 7 year period. And so you have these exit ramps, and that's the point. We don't have to exit all in one time. Right? You could do it in phases and stages. That's in industry jargon. We say apple bites, right?
Yeah.
The bites of the apple. Yeah.
Yeah. Well, and I think the other point is you're choosing your exit.
Yeah.
That's the point. To be in a position of control, right? Not that I have to sell or I've gone to this path. I can't go anywhere else.
Yeah.
Like you're now in the driver's seat. Truly.
Yeah.
Yeah.
Yeah, we have, brings to mind, we had this goalpost question at the very start of our assessing client, and it is just, kind of where are we going? We can design a lot of things for you. We build a lot of structures, people, process, technology around the accounting infrastructure and leadership. But if you want to sell the business 2 years ago and they're just begging you to get out versus you got a 1, 2, 3, 5 year time frame, or you're looking out in the future and saying, actually, I never want to sell this business. I want it to be multi-generational. Correct. These are that's the direction we're driving to go. But knowing that that's there, and so even with those ones that say we're going to be 5th generation, 10th generation, we never want to sell it, aspirationally, we'll say, okay, well, our job will be to run it as though but we'll look at it from that investor's mindset and perspective, because then, hopefully it's irresistible in the event that you don't have a choice, or one generation chooses that they're not interested, which is happening a lot right now across, a lot of construction businesses and things that are in transition. Next generation doesn't actually want it. So, okay, I'm going to let the asset die, or am I going to be in a position to go on it? It's right.
No, exactly right. In the stats, when we look at generational companies, progressively gets worse. I think by 3rd generation, there's like a 90% failure rate, typically, which is, it's sad, obviously, because there's a legacy there that was started. We have some clients that they're centennial companies, 3, 4 generations, and so. But to those that say I'm never going to exit, they're wrong, because they are going to exit. The question is, are you going to exit internally or externally? And there's options for both. But I remind people that whatever they don't solve for today, the next generation is going to have to figure it out. So who's better equipped to figure that out? Well, typically, it's the founders or the owners of those companies that are in charge today. They know where the landmines are buried. They know where the problems are. So if they can spend the time that they have to prioritize how they're going to fix those things in the company, and there's many that we could talk about, that produces an irresistible asset for investors. And it enables them to pay healthy valuations with attractive deal terms, because The reality is, if we were to bring some of our private equity friends into this conversation, they'll say, you have plenty of money, not enough good opportunities in the market. And that's what collectively what we're doing is designed to create those desirable investments for these investors. And it starts with, and let's dive into financial leadership and as a competitive advantage. Because if you have that leadership and you're mindful of your financials and your reporting, the outcome of that is amazing. Because when you go through due diligence and everyone's asking a million questions, including the quality of earnings firm that was hired by the acquiring party, there's a lot to unpack, a lot to pick at. But if you show up to, we say, you don't want to show up to a gunfight with a knife. And it's the equivalent of that if you're coming to that meeting, a setting where, what I said earlier, just a P&L and a balance sheet, you're gonna get eaten alive. Yeah. Because it's not enough information for these groups to underwrite, to make an investment, whether it's an acquisition. It could be debt as well, right? Because they're underwriting very similar terms or similar ways. But how have you guys seen the work that you've done? How has it prepared your clients? And what were some of the positive outcomes that followed your advice? And we all listened to pay more. So also give some examples of those that didn't follow your advice and what was the outcome there?
Can we start?
Yeah, go for it.
So quite often we come in, the existing company either doesn't have a financial leader or the CEO owner's been the one that's in that seat trying to maybe fake it till they make it, figure it out, right? Just like we do with anything else in business, we're trying to figure it all out. So this introduces there's a level of complexity or cash flow. Having that other person at the table, that different seat, that different mindset at the table, who thinks maybe a little bit more in spreadsheets and a little bit more objectively. When the owner says, yeah, we're going to take over these 4 or 5 or 6 different things, the CFO sits back and goes, well, that's great, but that's not possible. Here's why. Let's pick the one that actually, we modeled it. This is the one in the 4 that will drive the most enterprise value. That's controlling. So this is the one that'll drive the most cash flow. Or, hey, we have a major debt, balloon payment that's going to be a year, so we can do all that, but we got to wait until January to kick off and to spend. Just that person in the room who's not saying no, but he's just reminding them of the other impacts so that you don't go 3 or 4 months down the line. When it comes to a sale, I think that the most amazing thing we do of our assessments is how much money is just sitting within the business already, because no one's peeled back a couple layers of onion to look at your software spend, to look at your insurance costs, to look at the programs that you just kind of accepted as this is what we do, because it's what we do. We've been doing it for 5, 10, 20, 30 years.
100 years.
100 years, 4 or 5 generations. And so our job in that is to say, okay, what's the dollar? If we made a change here, if we don't need this risk. We don't need to mitigate this risk with insurance. We can do it with safety program. If we're in a SaaS company, how many seats are actually being used for all those different tools that we have? And they're small. It might be 15 basis points, 30 basis points, 10 basis points. But then you get to the end of the assessment and you go, 4%, we found 6%. And it's none of these things individually are that hard to do. It's just a known key men to take time to do. So I think it brings a different perspective to the table rather than just let's grow revenue and sales will cure any sales issues that we have. Maybe on the exit side too, what's fun is sometimes we'll sit with a client. I think 1 or 2 years ago, it was in the retail space, and they were pretty sure they were EC online. And they were pretty sure that they knew they wanted to sell this for $100 million, but they thought it was going to take 3 to 5. That was their. I'm sitting there across from my controller, and we're looking at each other, just making notes. And so that night we're having dinner, talking through. Like, I think they're at 75. I think that if you look at their growth rate, top line, the gross margin, 10% above market. The bottom line is 15-20% above market, depending on the quarter. They were on a really nice trajectory, and nothing was slowing down. You go back to them and say, have you considered already talking to an investment advisor, analyst, banker, someone in the space, if not, I'm going to introduce you, because you should be having a conversation. You're actually not that far away. They had a lot of risk in that they were facing the business, so that took a year to work through and figure out. But again, they knew what they didn't know at that moment was because they weren't finance folks. They were design and retail, brand, and they mentioned that was all working just by having somebody sit in the room literally for a day or two and hear what's going on, open up an entire new window and that goal I had that was 5 years out, probably 12 to 18 months. I'm doing that if we want to, right? They're in the driver's seat, and it was irresistible. It was the irresistible. The irresistible story. So how this language you use on that?
Yeah.
Let's see ever.
Well, to use that word is not often used now because We even talk about, it's inevitable as well, right? And I titled my book, Inevitable Exit, because we are all going to exit to this in some way. No, I think that's important. Tell us, I know who wants to take the bad story. Who did not take your advice, and what was the outcome for that?
I mean, I'll speak just from firsthand, right?
Yeah.
So my first exit was 18. It was luck. It was just fluke of things falling together at the right time. But my second business was a marketing agency. I started in 99, and I built chaos. Like, I built absolute chaos, but there was so much cash. And so, when it was like me and a couple guys, it was fine. It's actually a lot of fun.
Yeah.
When we had to start building staff and building teams, we just threw money at problems. And so when it came time to sell, and it was my last 2 years, I cleaned up a lot.
Good.
I got good advice at that point, but there was so much that would have had to break down to rebuild that I didn't have it in me. I was burnt out. I was tired.
You're fatigued.
Yeah, and I sold, right? I made some money. It was a nice check, but they didn't buy. First of all, they didn't want me, right? So I didn't show I was a good leader, so they didn't want me. Two, they wanted some product that we built, some IP, so that was attractive, and the clients, but it wasn't this machine. So that sale, I mean, with what I learned now from being with clients, from sitting with them, going through their transactions, world of difference. And so, it's just that I didn't know what I didn't know, and I wasn't humble enough to go seek it out.
I would say too, one other idea that comes to mind is the pace that they'll the client move at. So maybe they're taking in advice, but it's in pieces. It's like, we'll do that this quarter, we'll do this next quarter, when they have an 18-month to 12-month time frame. So you need to do not all the things, but most of the things. See, it's in that cycle. So I think that maybe more so than that, most of their client book, they've built something that's doing well enough to say, hey, we want to grow, or they were in a down spell, we just did some correction financially. But when they want to actually exit, oftentimes the pain comes in when the banker comes back 6 months later, and you're having that next conversation. You guys haven't hit. You haven't done the thing. It's like, well, what's going on? We agreed to that, or we agreed to the strategy. The strategy is actually working. It's just you don't have the money quick enough. So that there's another gap, I think, in the pace that if the sell side.
Thank you guys for these case studies, but the punchline here is time and timeline and urgency is key. And you need to teach yourself what you don't know with good advisors. Not saying you didn't have good advisors in your situation, but you would have, even if you didn't listen, that's the other side of that equation, right?
Sure.
But the reality is, as we look at clients across the table collectively, we find, that they're not far to your case study. They're not far from their intended destination. They just need some fine tuning and be able to tell that story, not just with numbers, but yes, with illustrations and with descriptions and narratives and things of such. But that's the hope here. That's a hope in this for everyone, is that they built a company. The company's, in theory, doing well from a revenue standpoint. They're within, from a common size financial statement, comparatively, they're doing well against their peers. But are they positioned for that capital event, right? Whether it's a full sale, partial sale, or maybe they're looking at excess capital. I'll leave you with this story. We have a client, they win about $80 million of revenue. This is in the 4th generation ownership. They need about a $5 million investment, and that can give them access to a contract that's going to produce another $30 million of revenue in short order. And so they have a CFO. He's always busy, always behind schedule, because he was brought in to clean up, let's say, of the last 5 to 7 years. And he's doing a great job. But, in a situation like that, even when you have a CFO, that CFO is not focused on preparing the business for exit. He's just in survival mode. So he's like, let's get through today. And so this is where even if those listening have a CFO, it's still a good idea to bring in a fractional CFO, an outside party like you guys, to come in, provide the guidance, provide the urgency, and keep the momentum going forward as you prioritize what needs to be fixed and what that actionable advice is. And the outcome, as you and I know, is it could be tens of millions of dollars.
It's significant, positive. Well, and maybe to that point, they might not even be overwhelmed, busy. Maybe it's the first time they've actually been in a business. It's transacting, or it's a very different industry. So that's where like our CFO mentorship services will come in sometimes, or you have a phenomenal controller who's kind of doing a lot of that work and you don't have a CFO. Do we hire a full-time CFO just to come in and transact and be there? Probably not. Right? You need someone in the interim and fill the gap for a year.
Because the way you're positioned, you're not looking to exist, for years or decades, right? You want to get them through the transaction. Perhaps you're there to help them if there's any contingent payments, to make measurements, to follow that story along for 12, 24, 36 months, whatever it may be. But beyond that, you guys are there to support, to advise, and to execute. And that's what I really want listeners to pay attention to, because this is not a cost in the business. This is an investment. As we know, there's no ROI if there's no I. You have to make the investment. And then you'll get the return.
That's a great point.
Right, absolutely. Great point. Every time. I think that's one of the things we enjoy the most when we finish an engagement, when we get that dollar value.
It's a win.
Yeah, we charge the fee, we provide a great service, and we can circle the dollar amount that was worth, and then in transactions, obviously, is this new, but even in businesses 50, 18, 24 months out, then you start to have those business points back.
Yeah, you want 20% or 20 times return? Like, this is where you find it, right? It's amazing. Yes. Well, Brennan, thanks for staying here, coming in and being on the podcast.
Thanks for coming.
Yeah, for sure.
It's phenomenal.
Yeah, Josh, thank you as well. Appreciate the stories and the authenticity of your story. I've been through good transactions and bad transactions, which I talked about, but I always say I've never lost money in business. I just sometimes pay a higher tuition, and that's where we're at. Right?
Yeah,
that's the life story. For sure. Yeah, but thank you both. Appreciate you guys.
Thank you.
Looking forward to continue working with you both, and love to have you on again in the future.
Love to.
Awesome. Let's do it. Thanks. In today's conversation, I hope it resonated with you, because we talked a lot about financial cleanliness and readiness and leadership that's empowering the team to want to produce healthy financial reporting. For whatever the capital event is, a sale, a recapitalization, a leverage buyout, you make that decision. But before you could have that option or those options, you need to prepare yourself and your company. So we prepared a few tools. We have, of course, my book, Inevitable Exit. I'll plug it shamelessly here, inevitableexit.com. But we've also taken the concepts and the pillars of my book, and we've put this into the Empire Builder University. This is a system where you could come in a community setting, learn about everything we've talked about today. What are the acronyms? What are the words you should use? Why are you using these words, and what do they mean? And we take you through this journey, and we bring everyone together in a monthly community setting to talk about what we've done, because we do take things in 90-day sprints. You're not going to do this overnight. So set the table, set the tempo, and attack that. And join us at empire-builder.com to learn more. I'm your host, Brian Franco, and this has been another episode of the M&A Guy. We'll see you next week. Until then, keep building your empire.